It is our pleasure to have you, our friends and clients from around the country and the world, listen in as we provide context on the economy and the investment markets as we settle into early 2024. I'm delighted to be joined today by Lindsay Brock, a key member of our advisory and financial planning team, Jason Croy, a lead portfolio manager and advisor and member of our investment committee, and Glenn Joyce, our longtime partner and co-chief investment officer. Our intent today is not to make specific predictions, but help you understand the topography of markets and how that is likely to influence our portfolio direction this year. Please note, we were recording this on January 11th, 2024. Today was marked by somewhat higher than expected inflation reported for December, and also by the introduction of Bitcoin ETFs. Oh my. Importantly, subsequent events could greatly change this material. As always, no investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced will be profitable. Past performance is not indicative or a guarantee of future results. The investment opportunities referenced here may not be suitable for all investors, so please engage directly with your primary advisor here at SFG with any questions you may have. With that preamble, it's my privilege to bring in Jason Croy to lead us into the material.
Thanks, JT. So by way of agenda, we're going to spend a few minutes going over what different asset classes did in 2023. We'll talk about what drove those returns and use that as a backdrop to pivot into what we see as potential headwinds and tailwinds throughout 2024. And then we'll close out with a few opportunities of investment that we're evaluating for clients at the moment. So let's jump right into it. 2023 was a phenomenal year for most major asset classes. U.S. stocks were up 26%, non-U.S. stocks were up 15.5%, bonds were up 15.5%. And as a result, most of our client portfolios had a very good year. So we put a graphic down there at the bottom. You can see that a lot of the U.S. stock returns were driven by some of the biggest names in the market, a very concentrated handful of 7 companies. You could probably name them all. You're probably using their products right now that collectively were up about 60% or more. The other 493 stocks in the market were only up 13.5%. And so depending on how you were concentrated or how diversified you were last year, that really impacted your experience for U.S. markets and U.S. returns. But you can also see we put a measure of forward price to earnings ratio, which is a measure of valuation. And those magnificent 7, as they're called, are looking fairly expensive at the moment, while the rest of the market looks somewhat attractive, 15 times earnings. And so that'll weigh into when we get to the tailwinds and opportunities later in the deck, thinking about valuation. But it was such a strong year driven by a handful of companies. And thankfully, we did participate in that in a lot of ways for our clients. And the last point I'll make on 2023 returns, you can see that bar graph on the right. Just interesting to point out that even in years where you have such a strong performance of the broad market, there were still a number of companies, over 150 of the stocks in the index, that did not participate at all and actually fell in value. And so always areas of opportunity, always areas of risk in markets, and that's what we're trying to evaluate the best spots to be in for our clients.
Jason, one point I would like to make on this chart is all the way to the right, that bar chart you were talking about, the 154 stocks that actually performed negatively last year. That's really showing that there's always an opportunity. Every year there's going to be some stock, something that is down in the S&P 500, for example. So there are increasingly tools or investment structures that seek to be able to take advantage of tax loss harvesting. And we are able to implement those more and more in client portfolios, as well as do it on our own with some other products as well. So we're always seeking to look at that based on our client's personal situation.
Yeah, that's a great point.
I think maybe it's also worth noting just the round trip and how substantially things had declined in the prior year that then subsequently bounced back here in 2023.
Yeah, JT, I think that's a great point. And if you think back to 2022, the S&P 500 or large cap stocks was down a little over 18%. And so this year, obviously, you see that 26.3% number on the upside, a very strong year. But the round trip, if you consider both years, 2022 and 2023, the S&P is up modestly over that 2-year time frame. I think a little over 3%, 3.5% or so. And what's interesting also is we know the NASDAQ and that Magnificent Seven, a lot of those names are kind of representative of growth and technology, which the NASDAQ is kind of a poster child for. That index is still not back to where it was at the beginning of 2022. It's still about 3% or so below that threshold. So I think that's very interesting. And maybe just one other comment on bonds. You see that 5.5% number for this past year, 2023. Bonds were actually underwater for a good portion of last year. And the last 2 months, November, December 2023, bonds were up about 8.5%, which just shows it's not all about the yield, but also you can have some attractive total return when interest rates do start declining, or the expectation, probably a better way to say it, the interest rates are declining based on some of the Fed commentary, kind of the mirror image of what happened in 2022 when bonds were down about 13% because rates were rising so fast.
Reinforcing that total return piece, you
Yeah.
referenced that U.S. stocks are slightly up on a 2-year frame. That's truly only taking account of dividends. If you look strictly at the price level, they only just got back to the start of the 2022 levels in the last couple of days. So it's the total return that certainly is a key contributor there.
Yeah, and I was also thinking back Glenn, when you were talking about the bonds and their performance this year, U.S. stocks didn't have a straight ride up. U.S. stocks started the year very strongly, but then there was a more than 10% correction in late summer. It looked like things could go south pretty quickly, but thankfully the Santa Claus rally kicked in full force in November and December, and we ended the year with very strong returns on the market. So it wasn't a smooth ride by any means, but both stocks and bonds, the major asset classes, had a very strong rebound to end the year pretty meaningfully. Well, why don't we shift and take a little bit of a look at what was driving those returns last year. And so just to reset, Glenn mentioned 2022, a very down year across the board for all asset classes. Coming out of that, the Federal Reserve throughout 2022 raised interest rates incredibly aggressively. We'll look at that graphically in a minute. That led us going into 2023 thinking the economy really could slow down. The risk of recession seemed very elevated. Most economists would have put a high probability on the economy having a recession at some point in 2023, but that didn't happen. And we'll get into that a little bit further. But typically when you have an environment where interest rates have been increased so aggressively in a short period of time, companies were still battling inflation, wage inflation had gone higher. It was very well expected that companies would begin to lay off workers. And we actually saw that in large numbers at the beginning of the year. And we're nervous that might be sort of domino effect. Thankfully, it didn't. It was only a handful of companies that had major layoffs at the beginning of the year. And unemployment stayed very strong throughout 2023 and really drove the economy higher and kept the economy moving forward. Had that unemployment increased more meaningfully, earnings likely would have fell off more than they did. There wouldn't have been as many people working, therefore not spending as much money. That would have led to lower profits and eventually drove us into that recession. And so unemployment remaining strong really was the key driver that kept the economy going throughout most of the year. We put a note on there as well. We have to give a shout out to artificial intelligence that dominated a lot of the news stories starting in May. But the prospects for artificial intelligence and what that technology may be able to provide in productivity in coming years really propelled a lot of those growth stocks higher. And so the market benefited from that.
I think,
pretty
Jason,
meaningfully.
if I remember correctly, ChatGPT was introduced in November 22, right?
Yep, that's exactly right. Yeah, and so late 22, and then it really came to the mainstream news in mid 2023. I would also point out a couple of other things that happened in 23. There was a fairly meaningful banking crisis. Thankfully, it came under control fairly quickly, was contained, but that gave us a lot of pause and a lot of nervousness early in the year around the March timeframe. Not far after that, there was a government shutdown or government standoff around the budget. Thankfully, that also was resolved, at least temporarily. That's going to come back up in conversations here in 2024. But at least for the time, something that could have caused a lot of turmoil in markets subsided, and that risk kind of went by the wayside for the time being and allowed those other economic drivers to kick in and keep the market and the economy moving in a positive direction. And so started the year off with certain expectations that pivoted into a very different experience than what was anticipated at the beginning of that year.
I think just a great reminder that in every year there are going to be some squalls or some storms, and it's hard to read in the moment how substantial those are going to be. Certainly, there was a lot of concern that, as you referenced, unemployment, but particularly the banking crisis, had the potential to spiral at that time. Obviously, it abated rather quickly, and we're very thankful for that.
So let's take a look at a graph of what the Fed did over the past couple of years.
Yeah. So, I mean, first of all, I would like to acknowledge that there are a lot of lines on this chart. So I will try to call out a few of them and call your attention to make the main points here. But the first one I just want to highlight that I think most of us remember is the one all the way on the bottom, the dark red line. What it's showing is that in 2015, over the period of almost 3 years, the Fed interest rate was hiked up to about 2.25%. So they took a long time. This was the first time after the great financial crisis, and it took them a long time. They took it slow and easy to make that transition. The complete opposite, if you look at the bright red line all the way to the left, the one that almost goes straight up like the beginning of a roller coaster. It shows that the beginning of 1980, when because of super high inflation, there was a kind of single shot attempt to break inflation that was pushing from the 70s. So there was a big jump very quickly in interest rate. That did work. It did cause some trouble, some recessions. The question beginning in 2022 was, can the Fed do this breaking inflation successfully this time by orchestrating a soft landing without causing a recession? The other one that I do want to just call attention to here, because it's so close to the one that happened most recently, is the green that's right behind the dotted blue line. The green is what happened in 1972. Many of you might remember that period where there was a decade of stagflation, high inflation, unemployment. A lot of our clients actually bought houses, mortgage rates around 16, 17%. And you can see it was a smoother ride up. And so I think seeing that 2022, they attempted to raise interest rates to abate inflation, there was a slow and steady attempt, although it was quicker than in the past and in the most recent history in 2015. So that is where you can kind of see the attempt of the Fed.
I think we're all wondering about the opportunity, the possibility that the Federal Reserve may be able to pull off the proverbial soft landing or the immaculate disinflation. And so far, so good on some of those fronts. But yes, that dotted line shows that other than Paul Volcker's staring down inflation in the 1980s, this has been the sharpest and fastest increase in history. And that truly was the predominant story in markets during 2023.
Glenn, what else moved markets in 2023 other than the Fed, perhaps?
Yeah, Lindsay, that's a great question and a good segue here. I think when you look at this chart, I mean, I think you're looking at what was expected from a consensus standpoint last year, what actually occurred, and then the forecast as we go forward in 2024. And I mean, as you just kind of look at a summary of this, you've got growth, unemployment at the top, and jobs growth, and the S&P 500, the market returns at the bottom. I mean, you look at it and you just say, wow, especially when you look at the economic growth in the top left, the jobs growth, and then the S&P 500, boy, were the experts off. It was kind of a whiff, right? They really had kind of dire expectations coming into the year. If you think about it, as last year got underway or kind of leading into last year, most forecasters expected a recession to occur in 2023, a lot of them in the first 6 months. So we were really pessimistic coming into last year, and a lot of it just for the reasons we just described on the prior slide, in terms of that aggressive Fed hiking campaign and whether they could do that without sending the economy into the ditch. And so if you look at the growth at the very top, the economic growth, coming in close to 3%, and some of this is still was kind of the estimate as we got through November in the last part of the year, but still that's a very attractive growth rate. And you look at consensus was down below, like 0.25%. It was very, very dire. And so even though we're looking forward there, we're still seeing not too strong of a growth rate. And that's still the question marks to go forward. And it's going to be a lot of the underpinnings for a lot of things we're going to discuss is where is the economy, what's the growth rate going forward? And I think we are still seeing some headwinds, but I think obviously so far it's been much better than expected. We've had much more of a resilient economy. That ties into unemployment. I think we're still at historic lows, below 4%. You can kind of see that in the middle green bar. And so that's a big part of the economy, is that consumer strength, that ability to spend. And then tied into that is jobs growth. And once again, I think we had about 2.7 million jobs created last year, about maybe 2.25 per month. That's kind of what that number is, probably a monthly average. So once again, the jobs market has been very hot. It is maybe cooling some, and that's something we want to definitely look at, like, kind of every week, every month, kind of judging kind of how these layoffs, kind of these people that are looking for work, those reports are something we want to monitor. But right now, I think it's still very strong. And then you turn to the market and you say, wow, I mean, you've got about 2.5 years in one. I mean, the S&P probably averages, large cap stocks 9 to 11% per year. So you're getting about 2.5% times that just in 1 year. So it's important not to miss out on these years. And obviously that gets back to that contrarian perspective. Sometimes you come in with very pessimistic view, and sometimes you surprise yourself. So it does get back to a lot we'll talk about later in the presentation about having diversified approach and focusing on the longer term. But all said, we're not out of the woods. And I think you do see, as you look in 2024, there are still some concerns about a slowing economy and what that could do to the markets. And so I think that's something we're obviously going to continue to look at. And it's just good so far. The economy is much more resilient than we had thought last year coming in.
And maybe the big takeaway here is 2023 was banging from an economic perspective. It really was exceptionally strong, whereas the expectations were for pretty meh. And we talk a lot about behavioral finance and sort of anchoring bias, that your opinions on the future are closely related to the most recent experience. And so interesting to note that the consensus forecast for the S&P for 2024 is very modest. We looked at a different chart that force ranked the Wall Street prognosticators, and there's a huge range from pretty strong positives, 10 or 15% growth, down to 24% negative. The average is for very modest returns in 2024. Obviously, only the future will tell us what happened. But important to recognize those behavioral finance biases and not get too anchored in the most recent experience.
What was it that is often quoted by Warren Buffett? Be fearful when others are greedy and be greedy when others are fearful.
Right now, it tends to be a little bit of a greedy market. Good. So wrapping up on the what moved markets, I think, again, important to think about the environment we're working in. It's a pretty interesting chart. I'll explain what's going on here, but really the backdrop is how much inflation affects the reasonable valuation of stocks. We talk a lot about the price to earnings ratio, and that is sort of a measuring stick. What's the price of gas? You measure it in a couple of dollars per gallon. What's the price of a stock? You measure it in how much you have to pay for a dollar's worth of profits. So that's what the price to earnings ratio is. And arranged left to right here is describing that price to earnings ratio in different inflation climates. So it stands to reason, as you move from left to right, the blue dots, the price to earnings ratio, is going to be a lot lower, historically has always been lower when inflation is high. And that just makes sense. If you have a high rate of inflation, it means those profits that you're buying when you buy a stock are worth less. Those future profits, when brought back after inflation, are just worth a lot less. So price to earnings ratios are on average much lower as inflation increases. So where are we? We're really in that second category. The CPI has moderated tremendously from over 9%, during parts of 2022 to just under 4% today. This is still a debate of, can the Federal Reserve pull off getting to their 2% target without causing a recession? They've still got a long way to go, but many of the Fed members are talking about simply staying with interest rates will naturally get back closer to the target. But all that to say, our current inflation is a little under 4% and continuing to trend down a bit. And the price to earnings ratio, the total market, that red dot, is just under 20. So still fairly elevated. But as Jason described earlier, that is significantly boosted by the Magnificent Seven, those stocks most directly tied to artificial intelligence, which have a PE ratio well into the upper 20s. So if you disaggregate that and think about the rest of the market, the average price to earnings ratio being a little over 15 times, really all this to say, the core of the market for this inflation environment is not as elevated as it might at first appear. And that's going to set up some of our thoughts on where we want to participate in stocks going forward, is looking for those pockets that haven't run up as much, where you're not having to pay quite as rich a price to get $1 worth of future profits. Anybody else have other commentary around this concept? I guess maybe there's a little more substance than what might appear at first glance.
Yeah, I think that was well said. And it starts to do a good job, this, as we start to transition into where we see 2024 going. Just wanted to kind of wrap up this section with a couple of comments on inflation. Inflation was really what precipitated the Federal Reserve needing to be so aggressive at raising interest rates. And, just a couple of years ago, we saw those prints of 8.5%, 9% year over year rises in costs. That has come down materially. That dark blue line is this current inflation regime going back starting in 2019. It has come down materially. But as JT was alluding to, earlier today we got the latest inflation print, and it actually ticked up a little bit for the month of December. And something we just want to be cognizant of and just make sure we're not getting complacent with the way that we view inflation is shown in this graph. You don't have to pay attention to exactly which time period each line shows, but really just wanted to illustrate there have been periods in history where inflation has gone up meaningfully. Seems like it's come down and gotten under control, only to rear its head again within a couple of years, something, bringing inflation back into the picture. And we know that Jay Powell and the Fed are very mindful of these events. There have been periods where inflation has popped up and not had this wave pattern, and we're certainly not suggesting that that's what's going to happen. But we just want to, as we think through opportunities and risks over the next year or two, just be mindful that interest rates may be a little stickier than what the market consensus is forecasting. The Fed may not be quite as ready to drop rates as some may be hoping they do, just to make sure that inflation is under control and that we don't have this wave pattern repeat like it has in a couple of periods in history. So just thought it was interesting to illustrate that and really kind of set up what we're seeing as we go into, potential headwinds for 2024.
Yes, so that's perfect reinforcement that one of the bigger risks or headwinds that could occur is that those rates just stay higher for longer or even have to go higher. Again, the base case is that inflation continues to moderate substantially, but as you saw on that prior chart, in many prior instances, it has simply stabilized without continuing lower. So higher rates, we would say there's a moderate to high risk of that occurring, at least relative to the market expectations. The market, what drove that Santa Claus rally was very strong belief that the Fed was going to be dropping rates quickly as soon as March. That now seems a bit less likely than what was expected even 60 and 90 days ago. There's always the risk of a wild card on the geopolitical side. This year is fraught with a number of major elections, but whether you think about what's going on in the Middle East or the Ukraine, COVID would have fallen into this. Again, the market in the US at least has shown remarkable resilience to some major risk factors in those geopolitical environment over the last couple of years. There's relatively high headline risk as we look ahead in 2024. Several categories are in that low to moderate, where they could creep up, they could raise their head a bit more, but at the moment they seem not to be that high a risk. And those would include unemployment, the consumer spending. While it is decreasing, we don't see that really turning into a recessionary type environment. And similarly, a recession itself, it seems much more moderate to the extent we have a decline at all and possibly be able to achieve that proverbial soft landing. But the risk of the Fed misstep, Jason kind of set up for this, to the extent they overstay the high interest rates and that potentially driving us further into recession. So a lot of these are intertwined, but fortunately many of them are in the low to moderate category.
I might just add, I think JT, you mentioned it on a previous slide, but that behavioral finance piece, and we talked about it, right? I mentioned it about just how pessimistic folks were coming into last year. So it's kind of flipped, right? Now people are starting to get a little more optimistic. We're seeing different investment sentiment to indices start to move north, suggesting that people now are saying, hey, the soft landing scenario that Lindsay described is kind of maybe playing out. The Fed's actually getting this right, perhaps. And so I think now the risk maybe has shifted more on the psychological front, maybe to disappointment potential. That expectations bar has gotten higher. And so now I think, to me, that's kind of what I'm looking for, I always like the psychology aspect. And I think just kind of, I think to me, that's kind of a risk we need to monitor as well, just that disappointment piece.
Yeah, I like the phrase of what's already baked into markets, and you want to be measuring your expectations relative to what's already priced in. And arguably, the market has priced a very benign economic outcome, and anything that differs from that could drive price change.
I think what what we're worried about seeing is the risk that you can't see out the front windshield, right? So something a black swan event like what has happened in the past.
Yeah.
Can't build portfolios around it, but it's always in the back of your mind.
No.
So let's flip over and talk about some of the things that could actually juice the market or provide that tailwind.
Yeah, so this slide here, and JT, you mentioned earlier just how strong some of the economic data had been despite the expectations coming into last year. And so corporate profitability, and we saw the S&P 500 numbers on the previous slide, corporate profits have been much better than expected. And I think if you do believe, take the Fed at its word and kind of market expectations that interest rates are going to be coming down some, and we've already seen the inflation. I mean, once again, we were at 40-year highs on the inflation year-over-year number just last year. And so for it to be back down, kind of in that, getting that normal range, getting close to it, I think that is definitely something that will bode well for corporate profits and margins. I think margins have been averaging over the last several years in kind of that 9 to 12% range. Now, it wasn't quite as good maybe the last year or so, but I think once again, if we can kind of stay in that range, and I think the trend has been pretty consistent, back about 7-10 years in terms of corporate profit margins, I think we can see valuations being supported. So I think, right now there is expectation that corporate profits could do, pretty well. And I think once again, the economy is going to govern some of that. And so we'll be watching to make sure the economy does, stay relatively strong. And the inflation you see on that second point, that's a key point. And Jason and JT have already highlighted that maybe we are kind of in that last mile, and maybe there will be a little stickiness here and there, but the trend once again has been great from last year. And so that's something we want to continue to look at. And then economic growth. We think once again that expectations are soft, but we do think there's a good chance with some of these improving trends, especially on the interest rate and inflation front, taking some of the pressure off corporations, the economic growth could beat expectations. Now, the kind of fourth part here, the AI, we talked about artificial intelligence already and how that has enormous productivity potential in terms of helping corporations just be more productive and kind of keep those profit margins high. We think that's probably a longer term story. I think right now, a lot of companies are just trying to figure AI out and how they incorporate it. And so I don't think that's going to be something we're going to see quite as much traction early, but I definitely expect to see more and more of that in the coming years. And in infrastructure spending, you may recall there was about $1 trillion bipartisan bill passed, I think, 2 years ago, a very comprehensive package. And we're 2 years into that now. And I think we're starting to see that hit its stride. And so that's something that I think we could see much sooner. And you may start seeing some really nice, attributes coming in terms of how we're going to address roads, bridges, ports, the electrical grid, the environment, et cetera. And so once again, it's a very comprehensive package. So we like that one quite a bit. And that's one of the reasons why we have been advocating infrastructure, kind of real asset investing for a number of years now. I don't know if any other people have thoughts on these other tailwinds.
Yeah, I would just add in, we mentioned earlier how the labor market in 2023 was really what gave a lot of strength to the economy as people were able to work and therefore spend money. There's a very real opportunity that trend could continue in 2024. I think that a lot of companies had such a hard time getting labor over the past 2 years that a lot of companies are probably reticent to let folks go. And so, whereas in an environment like we've seen with these interest rate changes, historically, you may have seen companies more willing to lay people off in order to protect their margins or their profitability. I think right now companies are probably more willing to keep the workers on, especially now that inflation has gone, and so those future costs for raw materials and what in other areas have gone down. And so I think that could be something that keeps the economy moving if people can keep working and companies aren't, or we don't see the unemployment rate tick higher like it has in this type of environment historically.
particularly if they do anticipate even higher productivity going forward. Maybe just one related point to that. We have seen the interest rates abate a fair amount in the market. While the Fed has not really brought their rates down, market rates have come back. That relieves some pressure on corporate balance sheets in terms of how much they have to pay to service their debt. So all of that builds back to the corporate profitability line, that being the primary driver of stock prices long term. Consensus in the market is for roughly 10% increases in corporate profits, S&P 500 profits, in both 24 and 25. If that is achieved, that would be a tremendous tailwind, and that would be the sort of thing that could allow us to achieve much better than anticipated returns.
Talking about the individual and how this relates to individual consumers, I mean, I think there's no surprise here to see that since the COVID stimulus payments were made, which are the two peaks on this chart, personal household savings were quite higher than they had been pre-pandemic. At the peak of those excess savings being over $2 trillion, kind of at the end of 2021. Since beginning of 2022, that's been trending down. So U.S. consumers spent about $1 trillion as they were revenge spending, right? Whether that included travel or buying experiences and things as the world opened back up. But we still have about $1 trillion of excess savings. So although you can see the line is below the pre-pandemic trend, I still think this is relatively positive, as people still have a lot of money.
I think there's a very valid debate about the fiscal actions. Obviously, the government did a lot to try to bridge us out of the crisis during COVID that resulted in so much of this excess savings. It has come back. I'd say there's some other analysts suggesting that maybe is not quite as strong as the figures shown here, but still suggesting, there is still some support for the consumer maintaining their spending patterns for the next 6 to 9 months, perhaps. So, this is going to play its way out, but it still is providing some support. I think maybe putting this in context, there's increasing headlines around delinquencies, around credit card debt, those sorts of things. They are very meaningful. It is certainly concentrated, unfortunately, among some of the most challenged economic households in our country. But writ large, the share of consumer spending that's devoted to servicing the debt is still around historic lows. In aggregate, is not necessarily a headwind or portending a crisis.
Yeah, I know, JT, you mentioned consumer credit, but I mean also student loan payments restarting up, and how many are having to begin payments, or whether there are delinquencies that you mentioned.
So not to minimize the effect that it has on specific households, but at the economy-wide level, not each in their own right material issues right now.
Yeah, I think the other thing I'd mention is kind of post-pandemic, there was kind of everybody just kind of was wanting to get out from being pent up, and it was a little more caution to the wind. And with this excess savings, there was a lot of wherewithal just to kind of take these higher inflation prices and just say, hey, life's short. Let's travel. Let's do this and that. And I think as we see that excess savings coming down, and once again, when we talk about inflation being much better in terms of the year-over-year numbers, we do recognize that over the last several years, prices have gone up quite a bit. So I think that's my concern, is that discernment as you start getting your savings kind of coming down a little bit and you start seeing where prices are, maybe you are a little more deliberate or discerning in what you spend money on. And so I think that is something we're definitely watching. And I think it's consumer spending. Obviously, it factors in about 2/3 of the economic profile in terms of that growth rate. And so we definitely want to monitor this trend.
Obviously, the biggest support for that is employment, and employment remains robust. So American consumers legendary for they're going to spend, baby spend, so long as they have a paycheck.
That's a great point.
Yeah. I know, Jason, we talked about bond returns a little bit at the beginning of the presentation, but I know that's been a big story.
Yeah, so as we start to pivot a little bit and start to look at opportunities going into this year, wanted to highlight bonds a little more in detail. This chart has a lot of numbers on it. Really what it's trying to show, if you look at those circled numbers in the middle, the starting yield of where you buy into a bond or a bond fund matters. And that's really going to be predictive of your outcome in that investment. And so that green bar just highlights a 10-year period starting back in the mid-60s, where the interest rates were around 4.25%. And through that 10-year window, market interest rates actually increased by about 3.6%. And remember, rising interest rates are a headwind for bonds or bond prices. But if you hold to maturity and you're able to reinvest your interest payments at higher and higher rates along the way, you actually ended up with a pretty good return, about 4.7%. The red bar, a little bit of the reverse. Starting in 2006, interest rates were at 4.5%. They decreased over the next 10 years, but an investor would have walked away with about a 4.25% return. And so the takeaway is, you buy in around 4.25, you end up with an investment total return of around 4.25, plus or minus a little bit of spread based on what the prices of bonds do along the way. And so right now, market interest rates, or if we buy into bonds, we're buying in around 5%, maybe a little higher in some cases. And so over the subsequent years, that should be the reasonable expectation of what those investments should return in portfolios. So where we've been very underweight bonds for a number of years, I know we've talked with a lot of you over the past year about how we've increased bond exposure little by little. That's something that we're going to continue to talk about in the months ahead, building back up that core building block of a portfolio now that interest rates are attractive and that we feel that rates are likely hitting their top. It's not likely that rates are going to go much higher from here, though there are scenarios where that could happen. But we think now is probably a good time to highlight that bonds could offer a decent role in portfolios that they haven't played in several years now.
Hey, Jason, it may be clear how bonds work when you hold them to maturity with individual bonds, but how would that work when holding a mutual fund or another structured product?
Yeah, that's a really good question, because most of our investments are in funds. It's important to remember a fund is really just a group or a pool of individual bonds. And so if you buy into a passive index type product, those products are just going to hold the bonds or buy the bonds that are currently representing the market, and they're going to hold them to maturity. And as those bonds mature, they're going to replace with whatever the on the run bonds are in the market. If you're with an actively managed fund, the portfolio manager is going to be well aware of bond dynamics, and they're going to make the decision of when to hold to maturity versus when to trade, because they think they can get a better opportunity in a different investment. But overall, if you're buying a mutual fund and the underlying portfolio has an average maturity of 5 years, then whatever yield or interest rate you buy in at, you should expect over that 5-year time frame for that to roughly be your return expectation. Again, plus or minus a little bit of a wiggle room there. And so bond funds, they're a good way to get diversification in a single pool. And they're going to have a lot of the same experience that you get with individual bonds. You just don't control the actual timing of the reinvestment. You outsource that to a manager or an index.
Well described, Jason. Thank you.
Yeah, I think the other point I would make here is that a lot of our investors have been taking advantage of the short-term yields, which are actually a little bit better, 5 to 5.25% roughly, on like 6-month CDs, short-term treasuries, money market investments, things like that. The only question there is how long those rates last. Obviously, that's based on what the Fed has done with the aggressive hiking campaign. So if they do start lowering rates sometime this year, then those short-term rates will start coming down. And when do you want to kind of lock in, kind of to Jason's point, into more of these maybe core bonds that have a little bit longer duration, longer maturity, and also maybe get some price appreciation if rates do go down. So I think that's the big dilemma for some folks, is trying to decide how long they stay in the short-term camp versus getting to more traditional bonds.
Which is perhaps the first area of opportunity that we're going to talk about.
Yeah, it's good.
And it's a really good point. Just to graphically show it, over the past several years, as rates have gone higher, the amount of money invested in money market funds has really ballooned. I mean, this is both on corporate balance sheets as well as in individual investor portfolios. And so just wanted to give a little bit of a visual of what that looks like. But to Glenn's point, as you meet with your advisor and as we have conversations with our clients, that's going to be something we talk about. It's something we talk about for the cash we hold in portfolios as part of the allocation. But certainly if you've had an above average amount in money market funds or short-term investments, well, maybe now's the time potentially to consider making a rotation. And so worth having a discussion with your advisor about that.
And that dynamic writ large across the whole economy may be another one of those tailwinds as you see money begin to shift back from the declining yield of cash towards traditional investments, be it stocks or other areas.
Yeah, good point. So why don't we shift in and let's kind of talk about where that money could flow, or where we would highlight as being the biggest opportunities at the moment in the investment world.
Very good. I think that the big picture, we've talked about it kind of throughout, that this is a year where there are a lot of evident risks. Sometimes those aren't quite as evident. So it, as usual for us, is going to start with good diversification. And so what we talk about here is more a matter of degree. So it's not black and white, the difference between a growth and income investor or a growth investor, but it's again a matter of how much you want to try and take advantage of those opportunities relative to your cash flow needs and other things. But as we've hit a couple of times in this presentation, this is a window of opportunity to rebuild your bond allocation. And we had talked about for a couple of years, particularly leading into and through 2022, we had been substantially underweight our long-term target allocation to bonds. This is a time to build that back. And you've seen us do that in a couple of ways. We had some precious metals, gold exposure in several of our strategies. We chose to enter that in the late 2018 time period. We've actually pulled back from that late in 2023. Not that we particularly dislike gold, but we can get good yield, as Jason described, in the bonds. Gold has a store of value and a hedge on geopolitical risk, but now we think bonds can play their traditional defensive role as well as provide some nice yield or income along the way. So, this is a good window of opportunity that may be closing if we have a substantial recession or if the Fed just begins to back away on the interest rate curve. On the stock side, in both categories, we are emphasizing the quality and I would say even more of a bit of a value theme. So not so much of the artificial intelligence craze or the growth opportunities. Many of those may still be stalwarts, key parts of portfolios. But given the pricing, as we alluded to earlier, that's just something that we don't want to emphasize as much. And so we're leaning towards things that have more exposure across the spectrum of market capitalization and have more of a value orientation, quality, dividends, et cetera. To further broaden the diversification, we still like different types of private or alternative investments. Private credit has a high yield, so it shows up more on the income side. Infrastructure and even private equity and venture, the more you get out in the growth space. Glenn alluded to infrastructure, extremely hard to replace assets that have a nice income dynamic and also some inflation hedge in them. That's an asset class that is broadening out in its accessibility, and we're taking advantage of that in a couple of different ways. And certainly on the true growth side, while there's a lot of money that's been pursuing things like private credit, private equity, venture, that inevitably is going to create some excesses or pockets where folks get out over their skis. We do still think these private assets can deliver a higher average return and benefits from non-correlation. So there is, in many cases, it's about finding the right kind of partner, the right direct manager to help you have the selectivity among those opportunities. And that's what we spend a lot of time helping to select for our clients.
Yeah, and I would just add in, you mentioned it briefly earlier, but over the last few years, there have been a lot more products that are much more accessible on the private, or make the private markets much more accessible to a broader array of clients. And so increasingly going forward, you'll hear us talk about that and talk about it in meetings, looking for opportunities that we can add some exposure to private markets, either on the income side or the equity side, based on your risk profile and risk tolerance. But something that we think we have a lot better access to these days that we didn't have in the past. And so it'll increasingly be a part of the conversation, because we do think it can add, as JT said, diversification, but also a potential return opportunity. We want to take into consideration in light of the risks associated with those markets.
I think, Jason, you had a key point. I think when you think about just the opportunity set today, I think diversification, there's just much more opportunity, I believe, as you look forward. And I think just the ability to improve that kind of risk-adjusted return potential. I mean, you think back about almost 15 years now, the S&P 500 for a traditional investor, I mean, that's been a tough benchmark to beat, and diversification hasn't added as much benefit as we normally see. It's been a very strong year for U.S. Large cap stocks. It's been a great place to be. And we know the story on bonds last decade. It's been, interest rates are just now getting back to a place where bonds are getting attractive. And then, as you described already, some of these private areas offer a lot of appeal and different return streams. So I think, if I'm an investor looking forward, I'm thinking there's just other opportunities beyond just, we're always going to be biased towards U.S. stocks, don't get me wrong, but I think there's other areas of the portfolio that haven't necessarily pulled their weight. It's like international stocks, for example, have lagged considerably. And we've tallied some of that. The reason why they should do better going forward, the proof's still in the pudding. We'll have to see if that materializes. But I just believe there's a lot more areas that should be supportive and competitive with U.S. stocks as we go forward. And I think U.S. stocks have a great future as well. I just think there's more diversification opportunities, and I'm excited about it.
Maybe just to coalesce that a little bit more as you think about the U.S. stock environment, this is not a prediction, but it wouldn't be too surprising to think that the Santa Claus rally that closed 2023 sort of pulled forward some of the return opportunity, and particularly given the very strong performance at the very top of the market capitalization table, it seems that this may be an environment where you would be benefited by not being quite so simple, if I may, and moving away from the straightforward market cap weighted indexes to incorporate some of these other tools that we've referenced, obviously to a matter of degree based on your risk tolerance and your cash flow needs. And that's obviously something that our advisor team works very diligently to try to coordinate with our investment committee to design portfolios that really help you weather the storms and provide the withdrawals and the other cash opportunities that you need along the way. Very good. I will bring us to a close then and say thank you very much for your interest and attention. It's been a privilege to get to share some of our outlook. Again, our thinking expressed here is our own. It does reflect the consensus of our investment committee that we'll be continually revising as we move through the year and deal with the economic events and headlines that may come. But again, on behalf of Glenn, Lindsay, Jason, and myself, thank you for your participation and best fortune in 2024.